So a lot of people have been asking about ServiceNow stock. It's down right now. It might be, to some people, a value investment. Maybe you can buy it low and it'll reach a new all-time high later on. So I'm going to break this down to see if this is actually worth buying low or if this is one of those that could just keep sinking over time. Around 97% of their revenue actually comes from charging enterprises for their cloud-based platform, which automates IT, HR, and customer workflows. They also have 98% renewal rates, which is amazing. They also have something called Now Assist, which is rapidly monetizing artificial intelligence in there. And then the other 3% of their revenue is mostly like professional services. Now, their stock is actually down about 51% over the past 6 months, so these are some of the reasons why. So we have some investor concerns over their AI valuation and sector-wide tech declines, and that's in spite of beating Q1 expectations with 22.5% year-over-year subscription growth. And again, they are known for having very high renewal rates as well. Now, some analysts are saying the 30% year-to-date drop in their stock is way overdone, and this is actually a buy low situation. So with AI, they have a deep partnership with Google Cloud. They improved their cyber risk management by acquiring Armis, but they also bought back over $2 billion in shares in Q1, which indicates that they believe the stock is undervalued. So now that we know the backstory, let's get into the actual numbers here. Now, we already looked at the past 6 months. They're actually down almost 53% in the past year, and still down 12% over the past 5 years. So they peaked around early 2025 or late 2024. Now, their PE ratio is still pretty high at 52.87, and they don't offer any sort of dividend yield. So you are depending on this for growth. If you're wanting to invest in this, you're probably hoping to hold this long term and hopefully beat the S&P 500. Otherwise, why would you bother? Compared to the S&P 500 lately, the S&P is up only 3.5% in the past 6 months, but it is up 28% in the past year, almost 71% in the past 5 years. So being a growth stock that doesn't provide a dividend, that's kind of what the bar is. That's what you're really comparing to. Do you think it's going to outperform the S&P 500 over the next handful of years? If you do, it might be a great growth stock. If you don't, you might be better off with the S&P. I also like to look at quarterly numbers, and they're actually down almost 26% over the past 3 months, but we already knew that they've had a rough start to 2026. Now, if you look at their income statements here in March 2026, the most recent one, you're looking at 22% up on revenue, 17% operating expenses, net income up almost 2%, net profit margin down a little bit, almost 17%, earnings per share and EBITDA up as well. If you look at their assets to liabilities, looks pretty good, about a 2-to-1 ratio there. If you look at return on assets versus return on capital, I'd say return on assets is a little bit low. Return on capital is like right on the edge of okay, nothing that really jumps out. Cash flow may be one of the concerns of why there's been a sell-off here. It's interesting to see what customers are actually doing lately on Robinhood. If you look at what they're doing basically on a daily basis, it looks like more of them are buying low than selling right now. Hedge funds seem to be doing the opposite. They seem to be selling more than buying over the past few quarters, especially in the most recent one at 68% sell. Insiders were mostly selling in April, buying in March, and buying in February. So if you look at analyst ratings though, 90% of them give it a buy score, which is impressive. 8.2% hold, 2% sell, and that's out of 49 analysts, which is a decent sample size. There's also a lot of increased short interest right now. If you look at earnings though, it's been pretty solid over the past few quarters, as you can see, easily beating their projections over the last 4 quarters by a lot. If you look at their PEG ratio, it's a 1.6, which is actually quite reasonable. And of course, this is a great alternative to a PE where it actually uses growth in the determination of this number. If you look at their EV to EBITDA ratio, another indicator of whether or not it might be a bargain right now as an alternative to a PE. Currently, they have a 28.42 EV to EBITDA ratio, which over time they're saying is pretty good versus their competitors, worse than 77%. Versus their competitors, they're saying it's worse than 77% in the software industry, but I don't really take that number that much into account. I like to do some research on the leadership, and I think one of the best ways place to do that is to look at what their employees say about it, because they actually work there. They know a lot more than us outsiders do. It's been nominated one of the best places to work, one of the best led companies, and they are an engaged employer, all of which are very good signs. 4.2 out of 5 stars when it comes to the overall rating. So that's to put it in perspective. 82% would recommend working here to a friend. That's really good. The vast majority of people seem to like working here. 93% of their workers approve of the CEO, who of course is calling the shots, another great indicator of good leadership here. Before you make a decision on whether or not to buy, hold, or sell a stock, it's always good to look at the GICS sector that the stock is in and then compare it to what you already have to make sure you're not too heavy into one side to where you have a lot higher risk. So information technology, of course, is what this is in. And unfortunately, a lot of the top growth stocks are in technology. So you might have to make some tough decisions on what to keep and what to get rid of. This is a really tough one actually to evaluate, because normally when you see a stock that's kind of plummeting like this, normally they have much worse numbers across the board. And if you look at what they have going for them, I mean, they have some really good partnerships with companies like Google Cloud. They are apparently a company with really good leadership. They seem to be doing pretty well financially for the most part. They seem to be outdoing their projections pretty easily over the last handful of quarters. They had some stock buybacks, which means they're confident. Their renewal rate is over 95%, which is great. Most of their revenue is subscription based, and with that high of a renewal rate, that's really solid. It seems very consistent. Unfortunately, sometimes a stock just does not perform the way it should based on fundamentals, especially in the market we're in now, where everything just seems to be out of whack, basically. Do I think you could buy this? I think there's actually a pretty solid argument for buying this. I just don't know if I would buy a lot or spend, like, let's say, I like to use the example of, like, if you buy a certain amount or you have a certain amount of your income that you devote to buying stock every month, which is what a lot of people do. I don't know if I would use the entire month's worth on this. It also depends on how many tech stocks you already have. And the PE ratio is still pretty high. If you look at how they're doing, there are a lot of good signs, but yet they still have a high PE ratio. If something is this low, I would probably want a lower PE ratio, even though the PEG ratio is pretty solid, just to feel like I'm getting more of a bargain for my money, especially when you don't have any sort of dividend with this stock. I could see it being maybe a conservative buy if you are just someone who really likes to try and buy value stocks, but I think it's hard to say. I think a lot of people that are interested in investing or that already have portfolios, they probably have a handful of AI and other tech stocks already. I don't know if this is worth replacing one of the blue chip ones like Nvidia or Google with something like this. I don't think I would sell it just yet. I think if I already had it, which I don't, there are some signs that this could turn around and maybe even reach a new all-time high. So I would say it's more of a conservative buy, maybe a hold, but I don't think it's worth selling low just yet. Of course, it depends on your situation, depends on your allocation. None of this is financial advice, and I'll see you in the next video.